We're going to review the freeandclear.com Major Purchase Refinance Calculator, which is a mortgage calculator that allows you to determine if it makes sense to finance a major purchase such as college tuition or buying a car with a separate loan, or to refinance your existing mortgage to finance the purchase. Our Major Purchase Refinance Calculator enables you to compare the combined cost of your existing monthly mortgage payment plus a separate payment for a major purchase loan to the monthly payment for a new refinance mortgage. The calculator allows you to understand if you have enough equity in your property to refinance your existing mortgage, finance a major purchase, and potentially take cash out from refinancing. To find the Major Purchase Refinance Calculator, simply click on the Mortgage Calculator tab on the top left of any page on freeandclear.com, and that will take you to a page that lists all the calculators available on Free and Clear. The Major Purchase Refinance Calculator is listed under Mortgage Refinance Calculators on the right side of the page, and if you click on the triangle to the right of the calculator title, it reveals a brief description of the calculator. I'm going to click on the title, which will take us to the calculator page. As you can see from the way the page is laid out, the inputs to the calculator are on the left side of the page, and the outputs to the calculator are on the right side of the page. The inputs are the information that you provide or select, and the outputs are provided by the calculator after you click the calculate button. I'm going to walk through the inputs and outputs one by one. It's important to highlight that if you ever have a question about an input, simply hover your cursor over the icon to the left of any input rectangle, and it reveals a brief description of the input and the information required. The first input is the original amount of your existing mortgage. So if you obtained a $300,000 mortgage to buy your home, you would input $300,000, and that is the figure I'm going to use in this example. The next input is existing mortgage type. This is the type of mortgage that you currently have. And if you click on the drop-down menu, it shows three options: fixed rate mortgage, adjustable rate, also known as an ARM, and interest only. I'm going to select fixed rate mortgage in this example. The next input is the interest rate for your existing mortgage. This is your current interest rate, and if you do not know this information, you can either find it on your monthly mortgage statement or by contacting your lender. I'm going to use 5% for our existing interest rate in this example. The next input is the term of your existing mortgage, or the length in years of your current mortgage. If you click on the drop-down menu, it shows options ranging from 10 years to 50 years, and I'm going to select 30 years. The next input is your current monthly mortgage payment. In this example, our mortgage payment is $1,610. The next input is current mortgage balance. You've probably paid down some of the principal amount of your mortgage, and this is your current loan balance. Your current mortgage balance may be on your monthly mortgage statement, or you can contact your lender for this information. In this case, I'm going to say our mortgage balance is $250,000, so we've paid off $50,000 of our original loan amount. The next input is the estimated value of the property you are refinancing. This input will allow us to determine if you have enough equity in your property to refinance your existing mortgage. If you are uncertain of the estimated value of your property, you can use websites like Trulia, Zillow, or Realtor.com to find a preliminary property value estimate. Please note that lenders typically require a formal property appraisal from a certified appraiser, and the property value provided by the appraiser may be different than the estimate provided by these sites. I'm going to use $400,000 for our estimated property value. The next input is our major purchase loan amount. In this example, let's say we're evaluating a $40,000 college tuition loan. So I'm going to use $40,000 for our major purchase loan amount. The next input is the interest rate for our major purchase loan. So for our college tuition loan, let's use 6% in this example. Next, we have major purchase loan term, or the length in years of our college tuition loan. In this example, I'm going to say that our major purchase loan term is 10 years. The next input is the amount of your new mortgage. So if you decide to refinance your existing mortgage instead of getting a major purchase loan, I'm going to use $300,000 in this example, which is the original amount of our existing mortgage. The next input is new mortgage type. This is the type of mortgage you are selecting when you refinance. Again, we have three options: fixed rate, adjustable rate, or interest only. In some cases, when you refinance your mortgage, you may change the type of mortgage you have, but I'm going to select fixed rate mortgage in this example, which is the same as our existing mortgage. The next input is interest rate for our new mortgage. If you hover your cursor over the icon to the left of the drop-down menu, it shows the current interest rate for a 30-year fixed rate mortgage. In this case, the current interest rate is approximately 4.250%. You should select whatever the interest rate will be for your new loan, and if you click on the drop-down menu, it reveals a wide range of interest rate options. I'm going to select 4.250. The next input is the term for your new mortgage. In some cases, when you refinance your mortgage, you may change the term of your mortgage. For example, you may go from having a 30-year mortgage to a 15-year mortgage. I'm going to keep our mortgage term constant in this example and select 30 years. The next input is non-recurring closing costs, or the one-time upfront costs such as lender costs, title insurance, escrow, and appraisal fees you pay when you refinance your mortgage. The lender should provide an estimate of closing costs when they provide a refinancing proposal. I'm going to use $3,000 in this example. The last input is recurring closing costs, or the ongoing costs you are required to pay a portion of at the time of closing, such as partial interest expense from the day your refinance closes until the end of the month in which it closes, and potentially prorated property tax and homeowners insurance. Again, the lender should provide an estimate of closing costs when they provide a refinancing proposal. I'm going to use $1,000 in this example. We have submitted all of our inputs, and I'm going to click on the Calculate button, which will produce our outputs. The first output is current monthly mortgage payment. The next output is the total interest expense over the life of our existing mortgage. So this is how much interest we will pay the lender if we make the scheduled mortgage payments on our existing loan. The next output is the monthly payment we would make on our major purchase loan, our college tuition loan in this case, if we decide to finance it separately. And the following output shows the total interest expense over the life of the major purchase loan. Next, we have the combined existing monthly mortgage payment and major purchase loan payment, which is simply our existing monthly mortgage payment plus the monthly payment for a college tuition loan. And then the next output is the combined total interest expense over the life of the loan for existing mortgage and our major purchase loan. The next output is the monthly mortgage payment for a refinance mortgage, and the following output is the total interest expense over the life of the loan for our new mortgage. So if we decide to refinance, this is what our new loan would look like. Next, we have the amount of money available for a major purchase from refinancing. This is based on the size of our new mortgage less the principal balance of our existing mortgage. So this is how much money we have available to fund our major purchase if we refinance. Then we have net cash out from or required for refinancing. In this case, because our new mortgage amount is bigger than our existing mortgage balance plus our major purchase and closing costs, we were able to pay $40,000 for college tuition and take out $6,000. So this is money we can put in our pocket or the bank by refinancing. Next is the minimum required property value to qualify for your mortgage. If you're taking cash out when refinancing, lenders typically require that you have a loan-to-value ratio of 80% or less. The loan-to-value ratio is the ratio of your new mortgage amount plus recurring and non-recurring closing costs to the value of the property. This is a way to measure how much equity you have in your property. In this case, the minimum required property value to have a loan-to-value ratio of 80% or less is $380,000. So we can compare this figure to the estimated property value we provided in our inputs, and our property's estimated value is high enough to complete our refinancing. The next set of outputs compares our existing mortgage to our new mortgage and shows the savings from refinancing. The monthly mortgage payment savings or cost compares our existing monthly mortgage payment plus our major purchase loan payment to our new refinance mortgage payment. In this case, we save $578 a month by refinancing instead of obtaining a separate loan for our major purchase. The next output shows the number of months to recover our non-recurring closing costs. So this is calculated by dividing our non-recurring closing costs by our monthly payment savings. Typically, you want to recover your non-recurring closing costs within 2.5 years of refinancing your mortgage. In this case, we recover our non-recurring closing costs in 6 months, so half a year. The final output is total interest expense or cost over the life of the new mortgage as compared to our existing mortgage plus our major purchase loan. So you can see that we save over $60,000 in total interest expense in this example because we are able to reduce our interest rate when we refinance. It's important to highlight that you can change the calculator inputs without having to refresh the page. So if I change the interest rate for our new mortgage from 4.25% to 5% and click the calculate button, our outputs update automatically without having to refresh the page. And as you can see, our savings per monthly payment decreases and our months to recover our non-recurring closing costs increase because we increase the interest rate for our new mortgage. After you have reviewed the calculator scenarios that apply to you, you can click on the Compare Lenders button at the bottom of the outputs and review a table with interest rates and fees for lenders in your area. If you're looking for refinance proposals, make sure the refinance option is selected on the top left of the page. If you have any questions about the free and clear major purchase refinance calculator or any mortgage topic, you can always click on the Ask an Expert button at the top of any page and it will take you to the free and clear Ask a Mortgage Expert feature where you could submit your question. The feature is free to use and we never spam. We also encourage you to review the major purchase refinance section in our free and clear mortgage refinance guide, which provides a detailed discussion, analysis, and example of refinancing your mortgage to finance a major purchase. Thank you for reviewing the freeandclear.com Major Purchase Refinance Calculator.